Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. Today we put focus on Sebi's proposal on new asset class. This was notified yesterday. The new asset class is proposed between mutual funds and PMS, and the Sebi's proposal says the new asset class offers greater flexibility, higher risk-taking capability and higher ticket size. To discuss more on this proposal, what it would mean for the industry, we have with us Tarun Birani, the founder and chief executive officer at TBNG Capital Advisors, and Varun Fatehpuria, founder and chief executive officer at Daulat Finvest. And in a little while, we'll also discuss overnight funds and liquid funds with our guests. Tarun and Varun, good afternoon. Thank you so much for joining us today on this show. And we were going to discuss something else, but we got this overnight update that came by as well. So let's get started and understand what the impact could be here. Tarun, let me start with you first. Do the norms allow enough flexibility to offer higher risk return products? And what's your take on the proposal that has been put forth by Sebi?
Yeah, so good afternoon, Sonal. I think this new regulated asset class is a very welcome development, according to me. And I think as we are observing very high growth happening both in mutual fund and the alternate assets like PMS and AIF, where more than 60 lakh crores is there in MF and more than 10 lakh crores is there in PMS. We are observing that the way the industry is growing, SEBI is looking more from a long-term vision point of view. There is a need for much higher risk products available between the segment of 500 rupees to 50 lakh rupees. And that is the gap which is trying to be filled from this new asset class. Again, it has been observed that there are a lot of non-regulated entities which are playing in the market. So with this introduction of new asset class, I feel it is going to fill that gap, and more funds will come under SEBI ambit. That was one of the, I feel, is the main criteria. Again, it gives greater flexibility to fund manager to look at asset classes like long short funds, inverse ETFs. There are many sophisticated strategies which can be employed, which cannot be used in the current MF system. But again, due to the MF taxation as well as flexibility to invest with systematic investment products, I think it's going to bring in a lot of welcome stuff. So I it's a great move.
Okay, all right. So it's a great move, and you spoke about the other aspects which mutual funds or AIFs couldn't do. So this new set could do that. Varun, thanks for joining in. First, your take on the question: what do you think would the norms be? How do you look at this proposal? And mutual funds generally talk of 12 to 15% steady CAGR returns over a longer periods. Is there any assessment of what the return profile of such a product could be?
So hi, Sonal. Good afternoon. Thank you for having me back on the show once again. I would allude to what a lot Tarun has already mentioned about this new really investment product and not an asset class, so to speak, that is being proposed by SEBI to fill the gap between mutual funds and PMS. Firstly, I think it talks about the maturity of the Indian retail investor, where over the last 4 to 5 years, especially since COVID, we have seen definitely a surge of participation in the equity markets. And what we have been seeing over the last 12 to 18 months, that there are newer form of investments that are being marketed to these investors, often by unregulated, unregistered investment advisors, and to lure them in a pursuit of higher returns. And obviously, there is a risk attached to that as well. But these people do not have that sort of a risk-taking ability or really a ticket size where they can pursue a PMF or an AIF strategy. And I think that is the gap that SEBI is trying to plug, where they want to offer investors an investment avenue which is a riskier proposition than what an MF would be able to provide, since that's predominantly targeted towards retail investor and the masses of the country, but do it so in a regulated manner, in a segmented risk approach manner, while keeping things under control. So as you talked about, mutual funds as vehicle have been able to deliver returns in that range of about 12 to 15% over the last decade or so, even if you look at just the index. And these are products that are coming that has parallel to, let's say, products that are out there available in Americas or Australia for that matter. that is typically reserved for the institutional investors, but are being launched at a smaller ticket sizes. So definitely higher risk taking. The returns are yet to be seen because we are not really sure with respect to what sort of strategies today will be allowed apart from the couple of strategy which Sebi has already mentioned.
That makes sense. Tarun, coming to you, do you think the 10 lakh investment threshold is fair? And I know it's too early, but do you think the returns here, since the risk-taking capability is higher, could be higher than what mutual funds are offering?
Yeah, I think it is important to keep a minimum ticket size to make sure that more informed as well as investors who have higher risk taking ability only venture into it. If we look into this regulation which they're trying to bring in, I think the idea is to attract more high risk, high yielding products. All those things are they are planning to capture in that. So from a suitability point of view, this is suitable for investors who are highly sophisticated, who understand risk, and who want their portfolio to be much more broad based into strategies which are not available in the current suit. So I feel from a suitability point of view, this makes a lot of sense. But again, I have one point to make here is life is simple. One should not try to overcomplicate, but just to bring in new products, new idea. I have worked with clients with a very high portfolio, big portfolio in pure index and ETF portfolios. So with say 50 crore portfolio also can be managed from a simple index. What happens just to that recency bias creeps in the investor mind, and so many products going on. There is a lot of FOMO right now to invest into something or the other, and that's where investor get trapped into all these things. So though it's a very welcome move, but my advice to investors again would be to look at their suitability, their risk profile, and make a simple portfolio.
That totally makes sense. As you said, there's a lot of FOMO in this market, so anything new that comes up suddenly becomes very attractive as well. So it's important to do your due diligence. Varun, in that case, as Tarun mentioned, people might just look at this new product. Do you think this new product could take away some flows from traditional mutual funds if it actually does get the final approval? Is that a fear in the market?
So actually, I have a bit of a contrarian view where Sebi is trying to put this minimum 10 lakh ticket size, where obviously risk would definitely be a lot under control relative to, let's say, today a lot of the retail investor participation in pure F&A products, doing options, put option, call options, futures, right? Which tends to be a lot more on the riskier side, right? So having this 10 lakh rupees ticket size, I don't know how does that really fit in well, because you already have a huge chunk of the country, mostly people into their 20s and 30s, investing into FNOs with a significantly lower ticket size, but a significantly higher risk. So on the risk reward spectrum, it's completely sort of lopsided, so to speak, right? To your point, whether that takes away some of the business from mutual funds, I think, yes, there is some concern with respect to now people wanting to move beyond mutual funds and trying out more exotic products. I think that again speaks to the maturity of the Indian investor, where they have got a lot more comfortable with participating in the equity markets. So now they want to look at something which is new, which is something the flavor of the season, doing long short investing, which is perhaps what is permissible under this new asset class. So it remains to be seen what sort of a strategy do the AMCs actually come up with relative to the risk and the reward compared to more plain vanilla mutual funds.
Okay, all right. Take that point, gentlemen, and thank you so much for your expert advice, because it is still brewing. Of course, there's no finality yet, but these are the initial thoughts on this new category which is proposed by Sebi. We'll do one thing. We'll take a quick break. On the other side, we'll talk about overnight and liquid funds. When should you invest here? What are these funds used for? Stay tuned for that discussion. Welcome back. You're still tuned into MF Corner. We still have with us with our guests Tarun Birani and Varun Fatehpuria. This time we are going to focus on overnight funds. So, we talk about long-term investing. We talk about asset classes where you can make multiple amount of returns, but that is over a period of time. Let's talk about what do you do when you have to park your short-term funds. And that is where you can look at liquid and overnight funds. So let's get the basics out of the way. Varun, let me start with you. What is the idea of liquid funds and overnight funds? Is this suitable for a retail investor overall?
So, Sonal, liquid funds, overnight funds, both are, I would club under cash management solutions for retail investors. And it is really a good solution for investors looking to park their short-term idle money, what would have perhaps been kept into a savings bank account, or even for that matter, a short-term fixed deposit. People having that sort of a time horizon anywhere between, let's say, even a week to about 90 days, 120 days, they could look at liquid funds and overnight funds. What investors do need to keep in mind is that what they are able to achieve with a bank account or a fixed deposit, which is a high degree of safety and a high degree of liquidity. Both of those aspects are met when they are investing into a liquid fund and an overnight fund, and provide a significantly higher rate of return, at least in the current interest rate cycle.
Okay, all right, take that point. So this is what overnight funds and liquid funds are. Tarun, let me come to you. When do investors then look at liquid and overnight funds? How can they go about it? Because this is not your generic mutual funds where you can invest your money and forget. So what is your suggestion here?
Yeah, so I think liquid and overnight is mainly for so in the wealth bucket, you have three buckets, right? Safety bucket, stability bucket, and aspiration bucket. So safety bucket is you want to make sure that you have a contingency balance, your emergency fund, your short-term funds, your temporary parking of funds which you may require in short term, right? All those funds are the one which are recommended to be invested here. I think in terms of selection, you need to select the fund which is offered by most of the top fund houses currently, in both in the liquid and the overnight category. Liquid funds are mostly in the funds with the securities are taken within 90 days or less. I think those are the security which are taken in liquid fund. In the overnight fund, these securities are in the overnight call market, which is one day call market. So the returns are different for both liquid funds and overnight fund, with overnight giving lesser return because of the short nature of the investment. Again, in terms of selecting the fund, I have seen most of the returns of liquid funds and overnight fund of most of the peer groups have been more or less closer to each of them. So you should pick up the fund house which you are most comfortable with the parentage, and as per your convenience you can pick up. And expense ratios also need to be considered because some funds may have higher expense ratio which can impact the overall long-term returns of these products. So those also need to be considered, and my suggestion is to monitor them also as we monitor any other fund, because it is important to and I have seen particularly in the times of, let's say, 2018-19, in the ILFS crisis and all those times, I think there was mismatch of securities in the portfolios also. So it is very important to keep monitoring all the investment which has been done.
Yeah. Okay. Yeah, it makes sense. The total expense ratio would be different. Every asset management company would be different. So those are some aspects you need to keep an eye out on for as well. Varun, Tarun mentioned briefly how the returns are between overnight and liquid funds. But can you give us an average return? What does it look like for both these categories?
Yeah, so overnight funds today, Sonal, are ranging anywhere between late 6 to about early 7. And liquid funds are in the range of about 7.4 to 7.5% per annum. What investors do need to keep in mind is this is in the current interest rate cycle where the repo rate has been hiked by about 250 basis points over the last 2 years. And the returns that are made by both of these funds track the interest rate cycle, because essentially they are investing into underlying securities, which could be a commercial paper, which could be a certificate of deposit, which could be a T-bill. All of the returns are actually tracked and linked to a repo rate. So in the current interest rate cycle today, you are able to easily generate more than +3 or +4% relative to a savings bank account, which will give you about 3.5%, or even for that matter, a similar tenor fixed deposit which will not yield you more than 4%, right? So for investors having time horizon north of 15 days to about, let's say, 80 to 90 days, 100 days, overnight liquid funds both could be a very solid alternative to a bank account or a fixed deposit.
Actually, that was going to be my next question, but we'll discuss it in greater detail. We have to take a quick commercial break. On the other side, we'll continue our discussion with Tarun Birani and Varun Fatehpuria and understand more on overnight and liquid funds. Stay tuned for that.
Indian markets have not just grown, they've broken several records in the last 25 years. India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the
Welcome back. You're still tuned into MF Corner. We still have our guests with us. We are discussing everything about overnight and liquid funds. Tarun, let me come to you. We discussed this. What are the returns like in liquid or overnight funds? So should one go for a liquid fund instead of parking their money in a savings bank account?
Yeah, I think it makes a lot of sense to invest in liquid fund because compared to the returns what are generated from the saving bank account, it's far superior. And again, from a liquidity point of view, in one business day, these funds are accessible. So from that point of view, it makes a lot of sense to invest in liquid and overnight funds. Yes.
Okay, all right. So that's the general take, of course, because of the difference in interest rates in the returns on these two categories. Varun, let me come to you. Are liquid funds a good idea for parking your emergency funds then? And what should be the percentage of your emergency funds as a part of your overall savings or portfolio in that case?
Yeah, so Sonal, I'll take your second question first, right? I mean, in terms of what is the percentage of, let's say, portfolio that you should be looking at into parking into emergency funds. Typically, what we advise our clients is look at having at least 6 months worth of your expenses into an emergency fund that is easily accessible and that has a high degree of safety. Do not chase any sort of a superior returns over there. So that is typically what we would like to advise investors, that look at having 6 months worth of your expenses. If you want to be a lot more on the conservative side, maybe you have a professional job where it is not really stable, maybe look at pushing that up to about 9 months to about 12 months if you also have a lot of dependence on you. So that is what you should be looking at when you're thinking about emergency funds. Now, whether you want to put that emergency fund into a savings bank account, a fixed deposit, or a liquid fund, as we talked about earlier, there are two key criteria that you should look at when you want to invest your emergency fund. Number one, you should have a high degree of safety of your capital, since this is your hard-earned money and you would really require it at the time of emergency. And number two, it should be easily accessible. It should be highly liquid. It should not be locked away into, let's say, an asset class like real estate where it could take time to liquidate, right? And liquid funds actually ticks both of these boxes. There's a high degree of safety, and you could have your money come into your bank account within one working day. And even taking that a step further, there's an Insta redemption facility of about 50,000 rupees, where you get your money instantly into your bank account within the day itself. So that is how investors should look at emergency funds, and how they should be parking that into a liquid fund or an overnight fund compared to a bank account.
Okay, take that point. Tarun, last question before we let you both go on this interesting conversation. How do costs compare in a liquid fund with that of a long-term fund or arbitrage funds? Do investors have to shell out more money versus a long-term fund maybe?
Yeah. So basically liquid fund and overnight funds basically require very less management, and it's more like a very passive management, right? So from that point of view, the expense ratios are far lower, and due to the debt nature, I think they are available anywhere between 10 basis point to 30 basis point compared to long-term debt fund and arbitrage fund, which can go anywhere between 50 basis point to 1%. So from that point of view, there is a significant cost arbitrage. So if investors need to make a decision more from a suitability perspective, if they need the funds in anywhere between 1 day to 90 days, they need to look at overnight and liquid funds. But if they have, let's say, a 6 months to 1 year kind of horizon, in that case, arbitrage funds and other category of debt funds need to be explored.
All right, gentlemen, thank you so much for joining us today and shedding light on these two very important topics. One, of course, the new Sebi proposal or a new product category altogether, and the second, overnight and liquid funds. With that, we'll take your leave on this edition of MF Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.